There is a market most people never think about. It does not trend on social media. Nobody talks about it at dinner. And yet, this one market controls your mortgage rate, your car loan, your credit card interest, and the ability of your government to pay for roads, hospitals, and the military. It is called the bond market, and it is the biggest financial market on the entire planet, worth $140 trillion. That is 3 times bigger than the entire global stock market. And right now, in May 2026, it is quietly breaking. Let me explain exactly what is happening, why it is happening, and what it means for your money. So first, what is a bond? When a government needs money, it cannot just ask people for it. Instead, it sells something called a bond. A bond is basically an IOU. The US government says, "Give me your money today, and in 10 or 30 years I will give it back. Plus, I will pay you interest every year while I hold it." Now, here is the key thing most people do not understand. The government does not decide the interest rate on that bond. The market does, meaning the people buying the bond decide how much interest they want before they will hand over their money. When investors feel safe, when they trust the government, they accept a low interest rate. When investors get nervous, when they start doubting whether they will be paid back, they demand more. They say, "Pay me more or I am not lending you a single dollar." And that demand for higher interest is exactly what is happening right now. The 30-year US Treasury bond yield just hit 5.2%. That is the highest level since July 2007, right before the global financial crisis. The 10-year Treasury yield, the most important number in all of global finance, hit 4.7% just last week. These are not random numbers. These are warning signals. So why is this happening now? There are 3 reasons, and I want to walk through each one carefully. The first reason is inflation. Since the Iran war began in February of this year, oil has been above $100 a barrel for over 3 months. Right now, oil is sitting at $107 a barrel. And oil is not just fuel. Oil is the cost of making everything. It is in the plastic packaging of your cereal. It is in the truck that delivers your groceries. It is in the fertilizer that grows your food. It is in the factory that makes your phone. When oil goes up, everything goes up. Which is why producer prices, the cost of making things, just hit 6%. And consumer inflation, the price you pay at the store, is back up to 3.8%. The government's target is 2%. We are almost double that right now. And here's the part that makes this worse. Fertilizer prices have gone up 20% since the war started. But that price increase has not reached your grocery store yet. There is a 3 to 6 month delay in the supply chain, which means the inflation we are seeing today is actually the early wave. The full impact is still coming. The second reason is that the biggest foreign buyers of US bonds are walking away. And this is the part that should genuinely concern every American. In March 2026 alone, in just one single month, Japan sold $47.7 billion in US bonds. China sold $41 billion. Saudi Arabia sold $10.8 billion. Taiwan sold $12.7 billion. India sold $7.6 billion. The UAE sold $5.8 billion. The total foreign sell-off in March alone was $138 billion. And foreign investors also recorded a $142 billion valuation loss on their treasury holdings in that same month. Now think about what this means. When buyers leave the market, the US government has to pay higher interest rates to attract new ones. More supply, less demand equals a higher price to borrow. That is why yields are going up. Now Japan specifically deserves its own explanation because what is happening there is a doom loop. Japan is the single biggest foreign holder of US bonds, sitting on roughly $1.1 trillion. But Japan has a problem. The Iran war cut off oil through the Strait of Hormuz. Japan imports almost all of its oil, so Japan desperately needs dollars to buy oil on the open market. And where do they get dollars? They sell US Treasury bonds. But here is the trap. Every time Japan sells Treasury bonds, US yields go higher. Higher US yields make the dollar stronger. A stronger dollar makes the Japanese yen weaker. A weaker yen means Japan needs even more dollars to buy the same amount of oil. So they have to sell even more bonds, which pushes yields even higher, which makes the yen weaker again. It is a loop, and there is no clean exit. And China, at their peak, China held $1.3 trillion in US bonds. That was back in 2013. Today, as of March 2026, China holds just $652 billion. That is a 50% reduction over 13 years. And at the same time China has been selling bonds, they have been buying gold. Their central bank has now bought gold for 17 consecutive months. They now hold over 2,300 tons of gold officially. China is not panicking. They are methodically and deliberately replacing US bonds with gold. That is a strategic shift, not a market reaction. The third reason yields are rising is the simplest and most uncomfortable one. The United States government is spending money it does not have. The national debt just crossed $36 trillion. The government adds roughly $2.5 trillion to that number every single year. And the annual interest bill on that debt, just the interest, has now crossed $1 trillion per year. To put that in perspective, that is more than the entire U.S. defense budget. The government is spending more on interest payments than on its own military. And here's the thing about bond investors. They are not buying a bond for today. They are lending money for 10 or 30 years. And when they look at these numbers, when they see the debt growing by $2.5 trillion every year with no plan to stop, they see only one possible ending. The government will eventually have to print money to cover what it cannot afford. And printing money means inflation. And inflation means the money they lent will be worth less when they get it back. So they say, pay me more now, before I will agree to lend you anything. That is why yields are going up. Now here is where the Federal Reserve comes in, and why their situation right now is genuinely impossible. Normally, when something bad happens in the economy, the Fed lowers interest rates. Lower rates mean cheaper borrowing. Cheaper borrowing means people and businesses spend more. And that spending is supposed to lift the economy back up, but they cannot do that today. If the Fed cuts rates right now, with oil at $107, inflation at 3.8%, and producer prices at 6%. Bond investors will see that as a signal that the Fed does not care about inflation, and they will sell. Yields will actually go up, not down, because the bond market will revolt. But if the Fed raises rates, or even keeps them where they are, the U.S. government has to pay even more interest on its $36 trillion debt. And that $1 trillion annual interest bill gets even bigger. And here is what higher rates do to regular people. Mortgage rates go up, car loan rates go up, credit card rates go up, business loans get more expensive. And the economy, which is already slowing, starts to crack. Credit card delinquencies are already above 12%. Auto loan defaults are rising. The housing market has significantly slowed. The Fed is sitting between two bad options with no good one in sight. And the market knows it. Right now, traders are pricing in a 50% probability of a Fed rate hike by December 2026. 1 year ago, that number was basically zero. 1 year ago, everyone on Wall Street was betting on rate cuts. Goldman Sachs was predicting it. The bond market was predicting it. That was the whole reason Trump wanted Kevin Warsh as the new Fed chair, to bring rates down. That is not what happened. And this is not just an American problem. UK bond yields are at multi-decade highs. Germany, highest in years. Australia, Canada, France, all rising together. And Japan, whose 10-year bond yield has gone nearly vertical on a 20-year chart. 3 members of the Bank of Japan's board already voted to raise rates at the last meeting. But Japan raising rates creates its own problem. Japan has a debt-to-GDP ratio of 260%, meaning for every dollar of economic output Japan produces, it owes $2.60 in debt. If Japan raises interest rates, the cost of servicing that enormous debt goes up dramatically, which could break Japan's own bond market. Investors around the world are watching this and realizing Japan has no good options left either. So what does all of this mean for your money? Let me start with the stock market. On the surface, the stock market looks fine. It is basically at all-time highs. And there is a logical, if uncomfortable, reason for that. The stock market is betting that when things get bad enough, the Federal Reserve will print money to bail it out. And historically, that bet has been right. But here is the problem this time. The Fed cannot print money easily right now without making the bond market revolt. And if bond investors revolt, yields spike, and everything gets worse. So the stock market might be pricing in a rescue that cannot actually happen. And by traditional metrics, this market is extremely expensive. The price-to-sales ratio is at a record high. The price-to-earnings ratio is sitting around 24 times, historically very stretched. The dividend yield is close to a record low at 1%. You are paying maximum prices for minimum income, at a time when a government bond pays you 4.5% with essentially no risk. Think about that. Why buy a stock paying 1% in dividends when a Treasury bond pays 4.5% for free? Now let me tell you about 2 assets that are quietly behaving very differently from everything else. Gold. Central banks around the world bought over 1,000 tons of gold in 2024 alone. These institutions, the most conservative financial players on earth, are choosing gold over U.S. government bonds. Not because gold is exciting, Because gold cannot be frozen. Because gold cannot be printed. Because gold has no counterparty risk. In 2022, the US government froze $300 billion in Russian foreign exchange reserves. Every central bank on earth watched that happen and had the same thought. That could be us. And so they started buying gold. That is not speculation. That is the data. And Bitcoin. The argument for Bitcoin is the same argument as gold, but taken one step further. In a world where every major government is printing money and inflating its currency, you want something with a fixed supply that no government can inflate away or confiscate. And now we have actual countries making that bet. Iran has been demanding Bitcoin as payment for oil. That is a sovereign nation choosing Bitcoin over US dollars. That is not a small thing. Now there is one important development from this week. Iran has reportedly confirmed an unofficial draft of a peace deal that would reopen the Strait of Hormuz within the month. The White House immediately denied the report. But the bond market reacted anyway. The 10-year yield dropped from 4.7% to 4.47% in just a few days. That tells you everything you need to know about how tightly this war and these bond yields are connected. If the Strait of Hormuz reopens, oil comes down, inflation comes down, yields come down. If it stays closed, everything I just described gets worse. So here is the bottom line. The bond market is the most important market in the world. It is under more pressure than it has been in nearly 20 years. 3 of its biggest foreign buyers are walking away. The Fed is trapped between 2 bad choices, and the stock market is still pricing in a perfect future that may not come. I am not telling you to panic. I am telling you to pay attention to the market that actually runs everything. Because right now, it is sending a very clear warning. If this video helped you understand what is actually going on, hit the like button right now. Subscribe if you are not already, because next week this story is going to move fast. And if you want to know specifically how I am thinking about positioning for this, that is in the next video. I will see you there.